My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate and to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Earnings season, of which, of course, we're in the middle of, requires its own terminology. If you don't know the classifications, you won't know why stocks go up or down, because management rarely, if ever, says, uh-oh, things aren't going well. Tonight, after a day where the Dow inched up 27 points, the S&P advanced 0.28%, and the Nasdaq gained 0.61%, I'm going to explain to you the lingo, the terms you need to understand the action, not to mention recognize when the action's wrong. These are the actual terms that big money managers use when they're trying to figure out what to do when they're going through earnings season. First, let's start with the easy ones. These I call the continually good quarters. We just got a few of them today and tonight, none of which should have been surprised. But because of macro concerns, there were worries that the numbers might come up short. The first two great ones were Pulte Group, that's a home builder, and Sherwin-Williams, you know them, paintmaker. I'm kind of blown away by Pulte. Strong earnings, margins, orders are fantastic, cancellations so low, and expectations, wow, they beat them. It was quite simply one of the best quarters of the entire year. What's incredible is that tomorrow the Fed's likely to raise interest rates, and that should be hurting both the margin story and the forecast for homes. Yet it isn't. Every time the Fed tightens, it makes current homeowners less likely to sell because they lose too much money on their new mortgage payments, which are much higher. That results in a massive housing shortage supply, hence the endless strength in housing stocks. Sherwin-Williams, well, it rallies because there's strong demand for paint, coupled with a continued decline in raw costs. Margins expansion, yes. When expanding margins come when you least expect them, stocks go up big. Now, don't forget, they also have double-digit growth in protective and marine and commercial property maintenance. You know what? Residential repainting sales were good. Doesn't that make you think that maybe Sherwin-Williams, instead of being hurt by higher mortgage rates, is actually doing quite well? And it makes you think also that maybe you should be a buyer of Lowe's and Home Depot. Yes, you want to extrapolate from Sherwin-Williams because that was just too good a quarter. Yes, a continually good quarter, if there ever were one. Now, if there were a category for another consecutive great quarter, that would belong to General Electric, which reported sharply better than expected new orders and big business in services. By the way, that's where all the money is really made because GE's got this razor blade business model. You sell the engine to a plane maker, and then you repair and service it for years at 70% gross margins. The real kicker here, GE has yet to even spin off its Vernova renewable energy business, but it was a pleasant surprise with some really great traction in wind, currently onshore and soon to be offshore. I can't believe how quickly CEO Larry Culp has turned around a previously pathetic business. But then again, this is Larry Culp. Best there is. Alphabet also fell into the continually good quarter category when it reported a terrific number after the close tonight, citing acceleration of growth in search, in YouTube, and in Google Cloud. One could also argue, by the way, that Microsoft belonged in the consistently good category this evening. Now, I thought the numbers were fine, especially the giant Azure cloud business, but apparently not enough to keep propelling the stock ever higher, given its tremendous gains over the last 3 months. Now, I think it just came in too hot. Both are charitable trust names, and we will have full reports tonight on, for members only, of course, on each of these numbers in depth. You know, as I mentioned last night, I continue to fret about the Justice Department's monopolistic case against Alphabet, as I told you. But I recognize a continually good quarter when I see one. After the continually good quarters, what's next? Okay, we have another category. It's called the first good quarter. We just had two, one last night and one this morning. The first is NXP Semiconductor, the chip maker with a big presence in autos and the Internet of Things. NXP had been having a tougher time of it, but after this nice upside surprise, management said the trough is over, and the previous quarter marked the bottom in the cycle. This was the last bad quarter. This was the first. It was therefore we had the first good one right now. And I got to tell you something, I thought it was really good. When you get the first good quarter after a trough, you get a chance for a big run. I think this one in NXP is just beginning. The second of the first good quarters that we got was a bit of a shocker to me. 3M. This one's been dogged by litigation overhangs and some endless revenue and earnings misses. All of a sudden, though, 3M is beginning to put all these issues behind them, reaching a solid settlement with the most important groundwater spoilage claimants. Meanwhile, it's doing better in multiple divisions, including autos, highway infrastructure, sounds like an infrastructure bill there, huh? And even personal safety. CEO Mike Roman even raised his full-year earnings outlook to $8.60 to $9.10 from the original $8.50 to $9. That's how a big move begins. It belongs in the category of first good quarter. And for a serial disappointer, a first good quarter, and don't forget this is a dividend aristocrat, is a very big deal. Stocks don't tend to stop after their first good quarter. Now let's get tricky. If you want the most bang for your buck, but there's also the most risk, you should try to anticipate the last bad quarter. That means you have to get in before management says business is bottom. Dicey, but when it happens, it's incredible. It's breathtakingly rewarding. And that's what happened today with Charitable Trust holding Danaher, which now has put up 3 not-so-hot quarters in a row, but indicated that things could be getting better, or in some cases, couldn't get any worse. Now, Danaher makes high-tech equipment for the medical and pharmaceutical businesses. They're heavily reliant on both biotech and China, both of which are in bad shape. But that's why I smell a bottom and want to get ahead of it. As we told club members in our proprietary morning meeting, we'd buy Danaher right here, right now, if we weren't restricted by our own discussion, because we think this quarter truly marks the bottom. If I'm right, the last bad quarter of Danaher represents a tremendous buying opportunity. Next category up is the first bad quarter. Oh, no, we don't want these. The winner and new champion of that category is RTX, the company formerly known as Raytheon Technologies, which is having a giant recall of engines that's going to put the wood to the free cash flow. RTX totally kiboshed a story about record string of quarters and fantastic orders. Just brutal. CEO Greg Hayes had to come on Squawk on the Street to spell out the considerable cost to the company and its customers, where he told me there will be make goods. Keep those customers happy. Silver lining, RTX has 13% organic growth and a mammoth order book, perhaps the best it's ever had, as was the case with GE. RTX told you that anything aerospace is just blowout strong. They also had very good defense numbers, and it was the first bad quarter thanks to the engine recall, and you have to wonder if there's another shoe to drop. You always do. We addressed this one with club members as RTX has been in our bullpen a long time, where we consider our next move. And I have to tell you, I am a big Greg Hayes fan. I think he's a straight shooter. It may be the first bad quarter, and it actually might be the last bad quarter. Not sure yet. Finally, there are the quarters where the market may be just plain wrong. Now, we have one on later tonight, GE Healthcare. That's another Charitable Trust name where we've been waiting for the stock to come down because people don't seem to realize that you'll need their machines if you're going to do anything useful with all these brand new Alzheimer's drugs. I think GE Healthcare could be the biggest and best beneficiary when it comes to implementation of these amazingly important drugs. Why not listen to the CEO when we talk to him later? I like this story very much, but I want to learn more because it was a confusing quarter for some. Hey, you know what? The market was initially wrong about General Motors because it was confusing too. We had a decent quarter there, but Mary Barr, the CEO, glossed over the fact that there might be a strike that could really crush the earnings later this year. We know that the UAW are itching for a fight. GM was too glib about the whole matter, and its stock, which was up nicely, pirouetted back down when Barr prematurely dismissed any union worries. With this fiery new UAW leadership, a strike could be in the cards, no matter how much cooperation Barr thinks there might be. Bottom line, now you have the most important earnings season categories. Let's go over them again. You have the continued excellence, you have the first good quarter, you have the last bad quarter, you have the first bad quarter, and you have the confusing quarter. I know it seems cumbersome, but that's truly the behind-the-scenes nomenclature that fund managers use. You just have to figure out with what you got your hands on before you do any buying or selling. And remember, there are a lot of different grades of excellence. Alphabet truly put up good numbers tonight. Microsoft less so. but only because of the lofty expectations caused by a staggering run in the stock of what I always used to call Mr. Softy. Lori in Massachusetts. Lori.
Yes. Hi, Jim. How are you today?
I am good, Lori. How about you?
Good. I watched your show about a month ago, like I always do every day. And on that show, that particular show, you mentioned some Gen Z companies. And one of them was Celsius Holdings.
Yes.
And I've been watching that stock go up every day. Well, I finally bought it at 145.
Okay.
And I'm wondering if you have any thoughts about it maybe going
Yes,
up
I
a
do.
little
I think
higher?
you're in great shape, Lori. I love what PepsiCo's comments. They have a stake in it. What PepsiCo said about the quarter and the brand tells me that Celsius is in for the long term. We've liked it ourselves on the show multiple times. I think you're in great shape. I want you to stick with Celsius. All right, that might be cumbersome, might be a little difficult to understand, but before you do any buying and selling during earnings season, please make sure you're able to distinguish the good quarters from the bad quarters, what went right and what went wrong, because that will determine the direction of your stocks. Mad Money tonight. Subscribers to the CNBC Investing Club know that we've been focused on GE Healthcare. And after reporting its second quarter as a standalone company, I got to run through the numbers with the company's CEO. Then in a typical tightening cycle, consumer credit seems to fall apart. And over the past week, we've seen some cracks in this pavement. So is this a warning of things to come? I'm digging the situation. And the IPO market has been busy this summer. So what should you make of the newly listed stock of Oddity Tech? I'm sharing where I come down on the name. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.